and I'm going to jump into the stock market analysis, what hundreds of you have been waiting for right now. So we'll take a look. There is some important information. Please do read this slide. It tells you about our approach to the market and what we encourage you to do about using our information, especially the aspect of trade ownership. So I even have videos on that, on trade ownership, really important. And I do want to remind you that you can see our stock market analysis daily. Matt sends this out. It's fantastic. That is our snapshot light. So you get the information on the S&P 500. If you go to our website and just, you can see right in here, you can get that information. Just put in your name and email. There's no credit card necessary. And if you're not currently a member at any level, then this is a great place to start to get our free information every single day. You'll get that in email, and just come here and subscribe. All right, stock market, multiple time frame analysis and projections. I'm going to look at the comparison of the monthly S&P 500 versus 10-year yields. I think this is really important to this discussion. Usually I save the monthly work for the year-end show, and those of you that are not members that you want to watch the year-end show, you can watch it by becoming a free member or sign up at the front of our website for the snapshot light, and then you'll be able to see our year-end show. So I'm going to look at the monthly S&P 500 versus 10-year yields, and this is extremely informative. Then I'm going to look at weekly yields and the 10-year notes, because I think that's very important to the analysis. And I said earlier in the show, and if you're only here scrolling forward for the stock market information, well, bad on you. But in the beginning of the show, I talked about the fact that I think that the markets have it wrong in some way regarding what they're anticipating is going to happen from the Fed next year, and how soon they're going to cut interest rates and how many times. Back to the stock market, as I was talking about the importance of looking at the 10-year yield. So we're going to take then a deep look at the stock market also. And I think that you're going to enjoy seeing me use my proprietary indicators, and that will be beneficial to all. The first thing I want to look at is this. Let me get back in gear here. So this is 10-year yields and versus the S&P 500. And this is, just great correlations. We're looking at the S&P 500 back here to about 1998. And this line that you see right over there, that line is the TNX is what that is. Sorry, coming back here. So what I want you to see is that yields correlate unbelievably to the stock market. When the stock market is rising, as you see right over here, yields are usually rising. When the stock market is falling, it encourages the Fed then to start to cut rates, and yields are falling. Look at the amazing correlation going back here for 24 years, as you see that the prospects for the stock market are essentially the prospects for yields. So right over here, you could see what we're seeing is the stock market rising since 22 and yields going back to the upside. Now, you saw what happened here. The stock market had a downside move and yields moved back to the downside. But the stock market is moving up again. That is very important when you look at this. If stocks are going to continue up in 24, which of course all the bulls believe, then yields are not likely to fall. If yields are actually going to fall, then the stocks must have big risk. I mean, it's just the way it is. So if yields are going, if the bond market thinks they have it right and yields are coming down and the Fed is going to react, they're only going to be reacting to a declining stock market. You can see. So this looks like stock market moving up, and yields are likely to turn back to the upside. As you can see, that is just a blip on the downside. As you can see, you had a blip on the downside here, and then yields began to move up again. And you get lots of chop in yields, as you can see. And that's basically what happened in here. But is there a reason to believe that yields are going to move down? Well, if that's the case, there's reason to believe that stocks are going to move down. I think the Fed has it wrong. because I think the stock market is not going to do all that bad. And I'll tell you about that at the end of the year. And that means that you're likely to get a rise in here again in yields. If the stock market turns down and has a very big decline next year, then the market will be right and yields will be moving down and the Fed will be reacting. That's the important look right there as we look at the comparison, which says stock market, it has to break big for the bond market to be right. Is that going to happen? Well, that's a big question. Let's take a look here as we look at the 10-year yield. So I'm looking here at the weekly 10-year yields. I'm going to maximize this, and you can see that with the way the cyclical patterns are aligned, it looks like this break right in here that you see is not over, because you can see that this alignment says that yields are likely to keep coming down here for a few more weeks. The low in here is due sometime between the end of December and around the third week of January. So that means that you're likely to get yields still under pressure. And if there's a rally in yields, it's likely to come down again. And then you can see right in here, yields are likely to move up, potentially up here to 4.8%. Sometime in March or maybe April would be the peak in yields. Nobody is talking about that except me. This would be a shock to the market if that happened. So a look at what looks like some risk. Let me just get a little bit closer look in here, and you can see what that looks like. Yields moving down for a few more weeks, possibly testing 4.06. That was our most extreme target on the downside, and then moving up. Now, the fact that it broke 4.24 yield under that 78.6%, it warns of a major top. So that says to me the upside is likely not beyond that 4.8. But believe me, that will be enough to scare the market. Let's take a look here at the ZNs, because I'm telling you yields likely to go up into that March period. If I look at the ZNs, which are inverse, it should be telling me that there's going to be a move to the downside here in this market. And you can see in here that our projection is in the 10 years that they're going to move down and potentially get close to that low down over there at 1.05 if you're going to get up to the 4.8% yield. And how reliable is this period of risk that you see right in there? Well, let's look back in here for an extended period of time. I have the last 3 full harmonic cycles. I'm sorry, 4 of them for you to see. And you can see in here when you're in the 4th minor cycle and the corrective period in here, you get the biggest decline, and the biggest decline actually that belongs right here. I had it in the wrong spot. And then right over here is where the next one is. So we're looking for a decline in here out into March, which just is in a perfect alignment with, going back to TNX, the rally over here out into the period out there in March. And that tells you that there's a very strong likelihood that the market is wrong, and that we're going to see these 5 potential rate cuts that are priced into the market for next year change dramatically, at least out into that period of the late winter or early spring. That could be trouble for the stock market out into that period, because it would be quite a surprise. Let's take a look here as we look at the S&P 500 on the weekly and daily chart. And you can see in here that it looks like the market has made an amazingly strong period in here. I think I have a slight update to that. No, I don't. That's it. This is the last one. We'll look at the daily chart right over here, and you can see what's happened is that it's basically run flat through this whole period. And now coming up here, that 4607 is a very key number. And it looks like this period in here ended with just this incredibly swamped strong right-hand translation. That's coming because look at the slim ribbon. You can see very powerful. You can see in here the slim ribbon PO on the bottom giving you the upward signals of momentum resumption. And you can see in here on the weekly chart as this comes up in here into strong momentum on the reversal scout. I'm going to take just a little closer look in here because this side-by-side analysis is very important. You can see in here that the projection out into early part of next year could be a lot higher, even up to 4750 on the S&P 500. But there's likely a bump in the middle. And you can see right here that this minor cycle corrects on the downside. Whoops. Having tech problems today, as you can see. Corrects on the downside right into this period right here, right there, which says that that is sometime into right around February 1st. That could very well coincide with the yields moving to the upside into that February 1st period. I said March in the on the analysis in the interest rates, but it doesn't have to go that far. It could be only out into the late February, early February period. Here, right over here, is also a decline out into that same period right there. So that looks like what happens is that this cycle, which is now looking like it's moving up, is likely to roll over somewhere in here and then come down into that period into late January or early February, aligning with this right over here into late January or early February. That means that the next rally over here probably fails and fails pretty quickly. And again, this resistance area right over here, it was 4601 to about 4607, 4608 right there. In the weekly chart that is brought over here at 4607, we have it listed there. And this could be an area where it has some trouble in the stock market. Now, remember these cycles in here. This peaking at some point, coming down here into late January, early February, this rallying up here and then coming down on the daily chart into the same time frame. Let's look here at the NASDAQ and make a comparison to that. And you can see here, looking at the NASDAQ is making that much clearer to us because you could see that this cycle right over here actually came down, got close to that 23% into the slim ribbon, powerful, giving upside resumptions, and then beginning to move up. What does that do? It tells us that you're likely to get up here to the 16,170 up to potentially 16.5, let's just say, if it runs a little past that, 16,480. That's this period right in here. And then these come down, yes, into the late January to potentially early February period. Same thing right in here. So I believe that that period where interest rates are likely to move to the upside is projecting that you're going to get one move down over here into late January, early February, an attempted move, and then this comes down into April again. So that could be an extension of that period of higher interest rates. We're looking at a pretty choppy period over here into the first quarter of the year, and I think influenced by the fact that interest rates are not likely to go down anymore and likely to surprise the market and go up. The last thing I'm going to look at in here is the Russell, which has a life of its own, and the cyclical pattern's quite different. And you can see in here in the Russell that actually the cycle pattern is different. The low is due out over here in the third week of December. So in other words, potential pullback right in here, and then another rally out over here into January, and then a pullback into that same time frame into that about the third week of January right there. So this may get more in alignment. You can see in here, this pulls back into the February time frame once this peak is made, but there's a shot over here up to 1925 at the same time that there's a shot for the stock market to get up to 4750 in the S&P 500. So this a key time frame now after a pullback and then a rally here in the Russell, and then I think it's chop ahead out over here into the first quarter of the year. That's what we're looking at, I think. And I think that what I showed you regarding interest rates really makes a ton of sense to me. and that we're going to see a bond market move to the downside in the first quarter of the year and a pop in yields that is going to scare the market, and the stock market likely to be in a much choppier period with only minimal upside. Now, remember, we're trading up now. If on the extreme, it's able to rally up to 47.50, we're only talking about less than 4% more on the upside. I think that that's not a strong likelihood, but I need to talk about that when I look at the stock market. So